Hey, what's up, stock compounders? Brad here. So today is Friday. So we're going to talk about the 10 most popular stocks on the Robinhood investing platform over the last week. Okay. What are these millennial investors buying? So here are the top 10 in terms of number of accounts that added these stocks to their portfolio in the last week. Now, right off the bat, you can see something interesting. These top three companies are electric vehicle plays, and number 7 here is an electric vehicle play. So 4 of the top 10 are electric vehicle companies. Okay. Well, I should say SPAC is in the running to be an electric vehicle company. This is a special purpose acquisitions company, a blank check company that has made a bid. Supposedly, it's in the running to win the bid for an electric vehicle company. So this isn't even an electric vehicle company yet. But, I think because people have seen so much happening with Nikola, with Workhorse, with Hyliion, people are speculating that this blank check company is going to be the next Nikola or something like that. It's quite remarkable to see what's happening with the whole electric vehicle, frenzy. People are looking at Tesla, how much it's gone up, and there's so much FOMO in the system. So many people thinking, okay, where's the next Tesla? I can't believe I missed out on this. I should have seen it. What can I plow my money into that might, boom as much as Tesla has? It's pretty wild, guys. So the first three, like I said, electric vehicle plays. Number 4, 5, and 6 are the three largest public companies in the world. Okay. Apple number 1, Microsoft number 2, Amazon number 3. So it's kind of interesting. You have these kind of highly speculative electric vehicle plays, and then you've got, the three largest companies in the world. That's an interesting juxtaposition there. And then here at 8, you have Uber. We all know Uber rideshare and food delivery, kind of sharing economy business. Novavax and Blue, which are both seemingly plays on a vaccine for kind of the global situation that we're in now. So I just want to run through a few different metrics that I use, initial screens to kind of filter out investment ideas. So this first one, price to earnings ratio, okay? This is a measure of, how the price of a share compares to what the business earns per share of equity, per share of stock. Now, obviously, the lower this ratio is, the faster you're going to make your money back through earnings, okay? So with 152 price to earnings ratio, if this continued, this 152, it's a snapshot in time. But, if earnings continued to be the same for Amazon, it would take 152 years for me to pay myself back for this investment from the earnings of the business. So 152 is a very scary number to me. It says to me there's a lot more potential downside than there is upside. There's such a rosy future that's built in to the price of Amazon right now. And then you can see Apple and Microsoft here. The average price to earnings ratio right now in the S&P 500 is, I believe, 22 price to earnings ratio. So you can see Apple and Microsoft are both significantly higher than the average. Of course, they're incredible companies. We can tell that by this return on invested capital. The returns that these companies have been able to get by plowing earnings back into growing the business. Very impressive return on invested capital. But, a great business is not a great investment at any price. Okay. And to me, the prices are a bit frothy for both Apple and Microsoft. Obviously, particularly Amazon, incredibly frothy price for that stock. Now, these PE ratios that are showing X, basically what that means is there aren't any earnings for these companies. Okay. So there's no PE ratio because you can't have a zero in the denominator. It just doesn't make sense uh, in terms of, you don't get a number if you have zero in the denominator. Um, Tesla does have a tiny bit of earnings right now, but because it's so small compared to the price of the stock, it would be it'd be a nonsensical price to earnings ratio. So that's that one. This column, I think, is one of my favorites, quite frankly. Super investors. How many super investors own these stocks? Okay. And I got these numbers from Dataroma, dataroma.com. Basically, that website aggregates the portfolios of dozens of the world's best investors. Okay. So you can see what they've bought recently, you can see what they've sold recently, and you can see what they're holding. You can also search a ticker like Tesla or Amazon, and it'll show you how many super investors own that stock. So that'll give you a sense for, how many of the world's best investors have conviction in these companies um, as great investments. The other thing you have to know, of course, just because a super investor owns the company does not mean that it's currently a great investment. Price is very important when it comes to investing. I mentioned earlier, a great company is not a great investment at any price. It's important to know what you're paying compared to what the value of a stock is. And, in the value investor framework, the value of a company is really based on the present value of future cash flows. Okay. So anyway, we've got one super investor who owns Tesla. That was a buy just in the first quarter of 2020. So, people are starting to pay attention to Tesla. Particularly these tend to be conservative, very good investors. These investors tend to invest based on, earnings power, unlike a lot of these companies, which are purely based on speculation, not current earnings power, but potential future earnings power. Amazon has 16 super investors, Apple has 11, Microsoft has 21. Everyone knows these are great businesses. I doubt there's a lot of super investors buying at current prices, right? Based on these price to earnings ratios. And then Uber, 2 super investors own Uber. Earnings yield and return on invested capital. I think these are, if you had to distill your research down to 2 metrics, I think these would probably be a great 2 metrics to go by. Earnings yield is a measure of how cheap a business is. I made a video on earnings yield a couple days ago, how you would calculate earnings yield for a business. And then return on invested capital is a measure of how good a business is. And we really want to see I like to see over 20% in this column, return on invested capital. You can see here, if there aren't any earnings, you're not going to have an earnings yield or a return on invested capital. So a lot of these companies just don't have those. Now, this is probably maybe my third favorite column behind, maybe fourth, behind these 3. Value Investors Club. So Value Investors Club is a website where great investors submit investment ideas. And if they're judged to be, sound enough, they make it through. And you can see those write-ups on Value Investors Club. Now, where I have a month and a year here, there was a write-up for these stocks. So NEO had a write-up in March of 2019. Now this was a short write-up. So this write-up, the thesis was that the stock price was going to go down. Okay, and at that time in March 2019, the current price of NEO was $5. Okay, during March of 2019, it was $5. Now this write-up actually won an award as as a fantastic write-up, and NEO, shortly after March 2019, proceeded to drop. I think it was to like $1.50. So it was actually a great short bet in March of 2019. Now, of course, since then, the price is up to nearly $15. So 3 times as high as it was just over a year ago when there was a short thesis for this company. So, if that gives you any indication, unless a lot has changed in the business in the last kind of year and 4 months, it's probably a scary investment at the current price of $15. But if you're going to invest in NEO, definitely read this investment thesis write-up. Tesla, less than a year ago, Tesla was at $234. All right, now it's approaching $1,500. So this stock has gone up 6 times in less than a year. And of course, everyone wants to own Tesla now. It's as if the price doesn't matter. So Tesla's pretty scary to me at a price tag approaching $1,500. I would love to own Tesla, probably around $200 or $300. So it has a long way to come down for me to be interested in Tesla. SPAC, no write-up there. Amazon had a write-up just 4 months ago at $1,785 a share. So obviously it's up significantly since this investment thesis. Again, a PE of 152. There's no way I'm putting money into Amazon at the current price. Microsoft had a write-up just almost 2 years ago at $108 a share. It has almost doubled in the last 2 years. So, too expensive for my blood, too rich for my blood. And then the last company here that has a write-up, Uber. So $26 a share back in April. So in 3 months, it hasn't gone up too much. It's gone up, what is that? 20% or something like that. Now, I think Uber's probably worth around $36. So, at $33, you're getting about a 10% discount to value. I need a much bigger discount. I need a much bigger margin of safety than 10% before I enter into a stock purchase. But I gotta say, based on this list here, Uber's the only company on this list that I see as a prudent investment, to be honest with you. I'm not quite at the point where I'm going to call Apple or Microsoft a gamble. They're not quite at the price where I'd call them speculative. But if you're paying these prices for Apple and Microsoft, your expected returns on those over the long term aren't going to be very strong, guys. I mean, from my perspective, it's hard for me to see making 10% annually on Apple and Microsoft at these prices. Uber, I think you might be able to do a little bit better than 10% per year at the current price, but it's still not enough of a discount for what would excite me to buy Uber. I'd need it to probably get down to $24 a share before I start buying Uber. And And then I just want to show you guys one more thing. So Benjamin Graham, the teacher, the mentor of Warren Buffett, defined investing as an investment operation is one in which, upon thorough analysis, promises safety of principal and a satisfactory return. Now, safety of principal is really Buffett's rule number one, okay? Don't lose money. So, looking at these 10 most popular stocks on Robinhood, in order to adhere to those guidelines, safety of principal, there's not a lot jumping out at me in terms of safety of principal. Anything that's not earning money, I can't rely on my principal being safe with those companies. It's just, what am I basing safety of principal on? There's nothing there other than hopes and dreams of what that company can do in the future. 152 price earnings ratio, that is not safety of principal. Even 30 and 36, you can make a case for Apple at 30. It'd be a hard case. It'd be a hard case. I don't know why you wouldn't just invest in the S&P 500 index before you'd buy something like Apple at a PE of 30. The only company here that I could maybe see a case being made for safety of principal would be Uber. You've got a slight margin of safety there with a 10% kind of discount from my estimate of intrinsic value. So anyway, guys, it's pretty rough. 9 out of 10 I see as pretty speculative. Obviously, these companies that aren't earning anything are much more speculative than the biggest 3 companies in the world right now. But that's all I got, guys. I'm not crazy about what millennial investors are buying right now. I think they'd probably do a lot better to wait for more promising investment opportunities rather than kind of chasing things based on FOMO. That's what I see. I see a lot of FOMO on Robinhood right now. So I will leave you with that, and I'll see you guys in the next video. Take care.